welcome to Business Law. Now I'm going to introduce you to my team. That is Saya, Jan, Fai, myself, Oname, and Vidhan. Now we're going to talk about the agenda for the discussion today. We're going to see the legal structures of sole trader societies, trusts, trading trusts, companies, and then we're going to see some case study of Companies Act 1993, Financial Reporting Act 1993, and New Zealand Stock Exchange rules of the case study. Now I'm going to hand over to Jan to discuss more about the topic in detail.
Okay, I will first introduce the advantages and disadvantages of sole traders. I will then introduce the method for the sole traders to pay for their tax. After that, I will also make a comparison about the corporate society and unincorporated societies about their different law structures. So, what is a sole trader? A sole trader is a person trading on their own. They control, manage, and own their business. So, the sole traders control the business by themselves. They won't be influenced by the change of law structures sometimes. They get all the profits for their business, and the startup cost for them is really low. They don't need to spend a lot of money for their administration and even operation, and they have their private data, which is different from the companies. The companies need to publish their annual statement, but the sole traders don't need to do that. They always specialize in one area due to their small scale, and for the local communities, it seems to be more attractive. They also make their own decisions, which means that they won't be interfered by the others. So they can make their decision quickly and change them quickly to suit for the customer's demand. But there are also some disadvantages. One of the most significant disadvantages for the sole traders is that they have unlimited liabilities. It's like there is no distinction between their own asset and the company's asset. They should pay the tax and make the contracts and the debts all by themselves. If they spend more money than they have, then they have to pay them back, not only from their own business, but also from their own asset. One of the worst conditions for them is like if they have a bad management, or even just due to their bad luck, they have to pay the debts back with their house, cars, and even their precious collections. So it's a disaster for them if this happened, and if it will influence their family, their personal life, and their health. It's also very hard for sole traders to increase their finance and expand their skills. It's hard for them to benefit from the economies of skill, which lead to a higher price for the sole trader business. And they need to make decisions by themselves. The sole trader companies always lack of continuity, which means that if the owner died, then the business will finish. So how will sole traders pay for their tax? They always use the net profit through using sales minus the deductible expenses. If they have a higher net profit, then they will pay a higher rate of tax. Next, I will focus on the societies. So what are societies? They are always not for-profit organizations where members have common interests, including sport, hobby, and community interest. For the incorporated societies, they always have their separate legal entities. They have their own rules and purpose to organize before they registered. And everybody have limited liabilities. They have their own profits, but these profits can't be separated to the members in this society. As for the unincorporated societies, they don't have many rules before they become the unincorporated societies. And if someone join in or leave, then the agreement for them will be changed. Everyone is liable for the debt, and they can't sue or be sued in the court, which might be a problem, because if there are some disputes about running the companies, then nothing will be done to go over the problem. And there is no properties for the societies, which means that if someone want to gift properties for the unincorporated societies, then it's impossible. So, what are the trusts? Anunia will explain for us.
Hello, now I'm going to talk about the trust. As we all know that trust has, there are a lot of constituency that consists in the trust. First is the trust deed. As we all know, the trust deed is, it stipulates how the trust will operate. And then we have a trustee, and trustee, as we all know, can be any individual, company, partnership, etc. And there is an appointee who appoints the trust, and the trust holds assets and investments that we have to make sure that we remember this point. And then as we all know, all trust is for the beneficiaries. So we can have a lot of beneficiaries as we like. And for those beneficiaries, they receive income from trust's asset. So that's why there is appointer, trustee, trustee, trust, and the beneficiaries. So now we're going to see what are the trading trusts as defined by IRD. As we all know, IRD is one of the main components or the main institution working in New Zealand. So according to IRD, a trading trust is a trust that carries on a business. A trading trust has a trust deed, as we all know all the trusts have. So, and that trust deed confers wide powers and discretions on trustees. For example, as we are looking, the power to carry on a business. So that can be also valid, and then the power to hold non-diversified high-risk investments. That goes and applies the same to wide powers that is conferred upon the trustees. And they also have wide lending powers, as we all know, if they can have without worrying about the indemnity clause, which we'll look later. So then they can also make provision for a corporate trustee. And in a corporate trustee, it contains an adequate indemnity for trustees. So they just are liable for the amount of trust that they hold and not above and after that. And a trading trust may be used as an alternative to other business structures, as we all know, such as the traditional limited liability company. So that is why the trading trust is so different from original trust. So now we can look at the features of trading trust. The trading trust is often used to describe a structure in which a trustee of a trust is a limited liability company and not an individual or not a natural person. That is the difference of the main difference of the trading trust. Then this trustee can be referred to as a corporate trustee, as we all know that it has to be a company and not a natural person, so it can be called a corporate trustee or sometimes a trustee company, whichever you feel free to do. Then there is a corporate trustee, generally has few or no assets of his own, and aside from the trustee's right to indemnity, as we discussed in the last topic, that indemnity clause has been a wide bone of contention for so long now, and we are going to discuss that in one of the recent New Zealand cases between Levin and Ikua that has been going on, and we will see more in detail about that. And all the assets are held on the trust for the beneficiaries. That's the whole point of having the trust. And the trust is usually discretionary, which has been discussed a lot. Then, as we come to the recent case that we discussed between Levin and Ikua, the term trading trust has been more narrowly defined and identify a business operated by an assetless company in the capacity of a trustee for named beneficiaries. So the problem here was obviously the clause of indemnity. So that has been taken care of by this case. And trading trust also need to be distinguished from the business trust. Business trust is also the term that we come across when we deal with the trusts. And it is used principally as a means of succession planning. As we all know, in this age of one person passing on the generation from one person to another or to his grandchildren. The succession planning is really difficult to manage. So that's why this business trust comes into picture. And that is in conjunction with the family trust, where the trust holder shares in a company which owns the business assets. So we need to look at that as well. And now we're going to see the company, which is a UK multinational company, which is Deloitte Tom Shoe Limited. And it is incorporated and it does a lot of professional services as well, like auditing or giving auditing or accounting services. But many few people know that the Deloitte Limited is also the trustee of Deloitte Trading Trust. And that Deloitte Trading Trust is a New Zealand trust that currently employs a lot of staff. And that is also under the New Zealand Trust, and the Deloitte Limited, which is the trustee, holds the asset for them. Now I'm going to hand over to Bidan, who's going to look at the companies in detail.
I'm going to speak about the legal structures of companies. So what's a company? It's a separate legal entity, unlike trusts, sole traders, and it has its own rights and obligations different from that of its shareholders. Again, unlike sole traders and partnerships, a company must be recognized that ends with the name limited, but that applies only if liabilities of the shareholders are limited. That name, however, should be identical to the name of the company. To form a company, there must be at least one shareholders and director. Furthermore, a company can undertake any business activities provided that is legal. Companies have certain obligations. Some of their obligations are to pay tax on its profits, which is taxed at the rate of 28% in New Zealand. Now, this is different from that of a sole trader and partnership, where the income flows to the individual and is taxed at the individual tax rates. It also has an obligation to collect GST from its customers and pay the GST at 15% in New Zealand. Since a company is a separate legal entity, a company is responsible for its debts unless the directors or shareholders have unlimited liabilities. Well, the shareholders of the companies are provided with a number of rights and obligations by the Companies Act 1993. Some of these are: they have the right to appoint or remove directors by voting on a poll at a meeting of the company. Number 2, they have the right to put the company into liquidation, approve amalgamation or major transactions. Number 3, they also have the right to comment, discuss, question on the management of the company at annual meetings. Finally, apart from the rights, the shareholders also owe some obligations. Some of them are: they are liable for any amount unpaid on a share. They also assume obligations for any liabilities expressed explicitly in the constitution of the company. There are also some powers and duties of directors. Apart from power given to the directors to oversee the company, its resources, the Company Act 1993 also binds directors with some duties. Some of them are: they must act in good faith and in the best interest of the company. What is good faith and best interest will be interpreted by the court if a director is brought to trial for his or her negligence. Number 2, they must exercise care, diligence and skills as a reasonable directorhood. Number 3, they must exercise power not for their personal benefits or personal motives, but for the benefit of all the shareholders and employees. And finally, failing to do any one of his above duties would result in a lawsuit brought against him by a shareholder, employee or other parties. Now there is an important concept that needs to be understood when we talk about companies. They are subsidiary and controlled. A company is said to be a subsidiary of another company and is therefore controlled by another company if it holds more than 50% of the shares of the company. It can exercise that 50% of the votes in a meeting of the company, and with that votes it can control the composition of board of directors. The company that holds 50% or more interest or shares in another company is also called as a parent company or holding company. Finally, we'll briefly look at the financial reporting regulations for a company. Number 1. Every large companies must prepare financial report. The definition of large is defined in Section 4 of the Financial Reporting Act 1993, where a company is said to be a large company whose turnover is more than $20 million per annum and holds an asset of more than $10 million. Number 2. Similarly, every large company that carries on a business in New Zealand must prepare a financial report. Number 3. If a company has 10 or more shareholders, those companies will have to prepare their financial reports unless the shareholders opt out from doing so. Number 4. If a company has less than 10 shareholders, those companies will have to prepare their financial reports provided those shareholders hold at least 5% voting interest, and all of these shareholders by a total vote of 50% require the company to comply with for preparing the financial report. Finally, all financial reports must be prepared with the applicable financial reporting standards. Now, Phi will walk you through some of the case studies of Companies Act 1993 and Financial Reporting Act 1993. Over to Phi.
For the case study, we will look at the Company Act 1993 between Morgan Stanley and Jeffrey 2014. This case study is about transactions between a director and the company, which is likely to be a conflict of interest between the director, personal interest, and the separate interest of the company. The Morgan Stanley was the director and the shareholder of the Morningstar Enterprise, or MSE. Another of his company was Morningstar St. Luke. Morgan Stanley sold all of the shares in the Morningstar St. Luke to the Morningstar Enterprise, or MSE, to repay his overdraft current account with MSE. This was no formal valuations done on this share, and the price was determined after an informal valuations of land, building, and future developments by the financial management of St. Luke's projects. This means that it relies on feasibility study rather than the fair value. Moreover, at that time of that situations, MSE was in the financial difficulty. They fell within a year of the transactions, owning several $1 million to the creditors. And so, Morgan Stanley was charged in the sections 131 because it is clearly that he failed to act in the good faith and in what he believed to be the best benefits of MSE. And the second is 135. He engaged in the restless trading. The purchase of the share by MSE was likely to be a substantial risk of the serious loss to the company creditors. Moreover, it has the potential to cause the demise of MSE. And the last section is 137. No reasonable director would have to process this transaction for just only their benefits or their benefits of directors. So as you can see, all companies are registered under the Company Act. The Act allows directors have possibility to manage their own company. But at that time, at the same time, the Act ensures that the directors are accountable for their duty as well. So let's look at the next act. It's about Financial Reporting Act. Prince and Skoda is a director of Apple Fields, and they failed to fill announced account for Apple Fields for financial years 2011 to 2013. However, the Apple Fields claimed that they have relied on the professional accounting as why in that the generally accepted accounting principle require that any of its financial returns would need to be consolidated with their partner. And at these situations, the Noble Investment Limited is the joint venture of the Apple Fields, but it has refused to allow access to its financial information. So as a result, the Apple are prevented to filing the financial returns. And both of two directors was charged in the sections 14 is about the group financial statement don't give the true and the fair view of the matter that they related. The director of the company should give more information and explanations in order to give true and a fair view of those measures. And the second is section 18 is about the director should provide the true delivery copy of the financial statement and auditor's report within 20 working days. And the last section is about the financial statement of any issue or any group financial statement in relation to the group and not auditing. So the Financial Report Act was designed to ensure timely and transparent audited accounts so that the investor and shareholder were able to inform of the exact information about finance statement, circumstance, and the nature of the company that they have invested. So I will move on to the Saya, and then she will give more about the other acts.
Thanks, Pai. I am going to talk about a famous case study on New Zealand Stock Exchange versus Pine Gold Corporation. In this, I will also include what rules they breached and how they penalized by the New Zealand Tribunal. One of the biggest wealth management firm, Pine Gold Corporation, PGC, has been fined almost $300,000 plus costs after breaching New Zealand Stock Exchange listing rules, following a referred by the New Zealand Stock Exchange Regulation and the New Zealand Markets Tribunal. The breaches include failure to comply with the standard composition requirements and the filing of annual and interim financial information under the listing rule guidance of New Zealand Stock Exchange regulations. In addition, on October 29, 2015, PGC announced its independent chairman, Brian Mokrick, had resigned from the board effective immediately. A new independent director, Paul Diddley, was not appointed until May 23, 2016. This was determined to be in breach of New Zealand Stock Exchange main board listing rules as well, as PGC was without the mandatory number of any independent director. This was the third breach of its corporate governance obligation. New Zealand Stock Exchange Head of Market Supervision Jules Van Amersfoort says that the New Zealand Stock Exchange considers compliance with periodic reporting and corporate governance obligations fundamental to ensuring investors' confidence in New Zealand's capital markets. Mr. Van Armstrong says this reflects in part the tribunal's previously well-signaled intentions to increase penalties, particularly for issuers who have had repeated breaches. PGC's breaches fell within penalty band 3 under the tribunal's rules and were subject to a potential penalty of up to $500,000. Now, in the conclusion, overall, all the legal structures have their own merits and demerits. However, as our case studies dealt with the Companies Act 1993, Financial Reporting Act 1993 and New Zealand Stock Exchange regulations, we suggest that directors must act in the good and fair view. They should disclose all the relevant information of the shareholders and provide further information to give true and fair view. The other main reason to follow the legal procedure is that all the real beneficiaries like shareholders are able to be informed timely and transparency of the financial statement of the business. For the future research, we recommend that cross-comparison of doomed businesses such as financial companies can be done. It can also be benchmarked against successful businesses. This would help us model the problem more empirically. Thank you.